Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is popular platform speaker, software vendor, and best-selling author, Curtis Cloak. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about Jim Otar's methodology of actual marketing returns and how it affects the sequence of returns, all from Curtis's popular presentation, Cracking the Retirement Code, and his best-selling software, The Annuity Bulldozer. Well, Curtis, let's get into this. Jim Otar, I mean, this guy is a major player, mathematician out of Canada, and you and I are already drinking the Kool-Aid of actual returns, right? So based on that, when we go into sequence of returns, because if you don't buy actual returns, this is going to be kind of irrelevant. Would you not agree?
Absolutely.
All right, walk us through why sequence, and this you probably spend, what, 20 minutes on this on your seminar. If you had to go to his seminar for any one thing, this would be worth it.
Yeah, so this is, I'll go over this quickly. This is the educational slide we use directly with consumers to have them understand what sequence or order pattern returns really means. So let's just pretend we're talking about a client 64, they're retiring in a year, they got $250,000 of assets. And they walk in their door, and let's pretend for a minute what they want is a 5% distribution rate. Now, I'm not making a statement that that's right or wrong. I'm just saying, let's assume 5%, let's assume increasing that 3% a year. A year later, once we took the money over, they're expecting an income off that 250 of 12.5 if 5% is the number. If I increase that 3% the next year, it's 12.875, and if I do it 3% every year thereafter, 30 years later, if the client's still alive and still needing income, 30 grand. Now I'm going to use a pattern returns that's just made up. Doesn't represent an indice or any benchmark, but if I take all 30 numbers and divide it by 30, add them up and divide it by 30, it's 7%. Let's assume for a minute that the client, instead of 65, is 35. Okay, let's assume that based on that pattern returns, we grow at that average 7%. I want you to see that in the end of 30 years, prior to 65, they'd have $1.9 million. Now, there's nothing tremendously remarkable about that statement until I start looking at what happens when I turn on the income. Well, I end up not with as much money, but I end up with 712. Now, that, if you only knew how good that could be, you'd retire every day of the week, right? 5% withdrawal, 3% increase. I got 712. I started with 250. To illustrate the power of sequence returns and educating the client, there's a risk that's sitting right next to them that can hurt them, and they don't even know it exists because they haven't heard them yet. They've been in accumulation. I'm going to take all the numbers in column 3, and I'm going to keep the numbers exactly the same, but I'm just going to change the order. So watch what happens here. Every number in column 5 is exactly within that column a number that's the same as the number in column 3. The only thing I did was I reversed them. Now with 30 numbers, there's thousands of iterations that I could do this with. I'm only going to do one. I'm going to do just the reversal one. Understand, if I take those numbers, add them up and divide it by 30, it's the same 7%. Now here's an interesting fact though. Regardless of whether I had the pattern returns of 3 or pattern returns of 5, at the end of a 30-year period of time, I'm going to have exactly the same amount of money, regardless of what the order is, if the numbers haven't changed, other than the order. But as soon as I start taking distribution, sequence of returns makes me, in this example, run out of money long before I run out of breath. And so this is the sequence of returns problem that we're talking about.
I think most people look at this as the accumulating, let it ride, go ahead and change the 2 columns, it doesn't matter. But nobody's taking into account, well, in real life and in real retirement, we're taking money out.
Absolutely. And that's a math and science a dichotomy that people are just not wrapping their head around very well.
Okay, so when we're talking to, because you said this is really made for a consumer client, I'm thinking advisors are probably getting a lot of this out right now. So when we're talking about this is a major retirement risk, not a small point. This is a major retirement risk, and we have ways to mitigate against that.
Absolutely. You know, if we look at Jim Otar's work, this is his work. He took an age 65 husband and wife with $1 million, 80-20 mix. 5% withdrawal, 3% inflation, lasting for 30 years. Take a look at this. 52 years of back testing. So the previous slide was hypothetical, made it up. This slide was based on what actually happened from 1926. And what this assumes is that on January 1, husband and wife 65, 52 times. And they lived 30 years. So we're getting all the way to January of 2008. Take a look. Those blue bars represent how many times over that 52 periods of retirement you would have not run out of money by at least $1 30 years later. Okay? Now, this is the proof that not only sequence of returns risk is a bad one, but so is longevity risk. So what happens if I die at 75? If I just live 10 years in retirement, back testing this for all those years, never failed. Look what happened to the rest of the time. Look, if I just live 10 years longer, 30% chance of failure. This is Jim Otar's work. And it proves the point that longevity risk is the number one risk. Sequence of returns risk is the other big one in the room that people don't know exists.
Wow. For more information on how you can use Curtis's revolutionary retirement strategies with your clients and prospects to expand your practice, just click on the landing page address in the video description. We'll be right back with more from Curtis Cloak.
This is your website. Few people visit, and if it isn't attracting new visitors, it's not doing its job. Now you can drive more visitors to your website through dynamic content and email marketing with CreativeOne's Social Media Elite. Capture quality leads faster and easier. Engage your visitors with informative articles and videos to boost your online credibility. Plus, stay connected with existing clients and earn more referrals. All content is customized for you. It's time to introduce your website to the world. Call your CreativeOne sales team at 800-992-2642 or visit us online at CreativeOne.com.
In this segment, we're talking about why we use Jim Otar's methodology of actual market returns and how 1 year can make a difference, all from Curtis's popular presentation, Cracking the Retirement Code, and his best-selling software, The Annuity Bulldozer. Well, let's talk about this now. We've chatted about this in the last segment, but I want to make sure we get this. We're going to micromanage this because this is so powerful. We said sequence of returns is the big sleeper risk when we're talking about retirement planning, and we're going to add a few things in here. I thought when I first saw your slide, I said, can 1 year make a difference? Well, okay, it'll make a difference, but will it make a big difference? Marginal or big? Why is this slide worth it? Why is 1 year difference so important?
Well, we can start to see the risks that truly exist. Where I have, a 30-year duration. People you didn't live this long before. Now we're going to live a very long time. And so,
can I stop you there for a second?
Sure.
So longevity, because of our extended longevity on our timeline, this 1 year difference now is having major league impact.
That's right.
Yeah, never before.
We just haven't ever had to keep portfolios alive for so long.
Right.
And that's a new. And they're getting stressed. More and more, all while taxes are going up, all while markets are not performing the same way, all while interest rates are low. So let's take this whole conversation. Jim Otar did all this work, and I just think he does great work. But this is a 65-year-old husband and wife with $1 million portfolio. And they invest 80% in equities, 20% in fixed. And obviously, we know today with bonds and interest rates being where they are, we're not going to have nearly as much portfolio in the fixed income column as we had before. And we're moving a lot more to dividend bonds in our portfolio. So 80-20 mix is the example. And we're using this 5% withdrawal, 3% inflation, 30-year of retirement years for the last spouse to pass away. So let's take a look. We're actually looking, you can't probably see this from your screen, but from 1926 each and every year through 1978. And what we're projecting here, what the math is projecting, is that husband and wife is retiring on January 1 of all 52 of these years, and then they're back testing the 80-20 market, that market allocation based on what the markets actually did for somebody who retired each of those 52 years, January 1, and lived 30 years.
Okay, so rolling time frames.
Rolling time frames.
Okay.
So just to put it into perspective, when I retire, this couple, January 1, 1978, this math goes all the way to January 1st of 2008. This is not an old chart. We didn't include 2009 because of its anomalously negative ending year, so we kept it at 2008. And so it's 52 years of back-tested actual returns. Now you can see Jim Otar, it's his methodology. This was actually material that was published by a mutual fund company called Legg Mason.
And he's using the S&P 500 index.
Using the S&P index and the bonds. And so I want you to see that there are 19 blue bars represented based on the 52-year rolling periods, 30-year rolling periods. Now what this means, each of these 19 blue bars represents, based on what actually happened in the market with the 80-20 mix, the years they could have retired on January 1 and gotten all the way to the end of the 30th year and at least had at least $1. Now, we don't know how much they'd had in there without looking at the data, but at least they had a dollar bill. Okay, 19 times out of 52. Interesting, isn't it? This now tells us what they had the rest of the time that they failed, where 30 years was too long. And I want to point something out. So you can see it's all over the place. But this is the proof in the pudding that not only does sequence of returns have to be considered, but we've been talking a long time, Tom, myself, and others, the longevity risk is the #1 risk in retirement. It's the multiplier of every other risk. I don't know a better slide to prove that point than this one mathematically. You see, used to be when Social Security was established, people were dying at 65. So there was little chance very many would receive it. And of course, for many years, 75 seemed to be kind of the target. Well, let's just assume a 10-year period of retirement. Look, based on that back-tested actual math, doesn't matter what of those 52 years I'd have been in, no matter what the volatility or sequence or pattern or order, no matter what inflation or interest rates or whether I got sick and went in there, no matter what, I had enough. What happens when I stretch that out and increase it 10 years? When I increase it 10 years, now I have a 38% chance.
Okay, can I stop you there for a second?
Sure.
Okay, so if we were dying within a 10-year frame back in the day, sequence of returns wasn't that big a deal.
Well, he didn't care in 1926
Didn't matter.
what this chart said.
It didn't matter, okay. But because of longevity, we're stretching the timeline out. Sequence of returns now introduces as a new component in the overall mix, and it's a variable that cannot be set aside any longer.
Absolutely. And so what we're seeing is that pressure of the additional time and trying to stretch the duration, the lasting stability of a portfolio to be, there's more up markets, there's more down markets, there's more variability, there's more experiences in life, longer period of time for large medical expenses to apply, and so forth and so on. And the numbers reveal a 38% chance of failure if I live to 85, 10 years longer, 20 years in retirement, 38% chance of failure. At 90, 15 years longer, it's 53% chance of failure, and at 95, 66. Let's just go back to 38%, Steve. Now, imagine everybody, wherever they are today, get in their car and they drive home. If there was a 38% chance of failure getting in a car today, none of us would get in the car. If there's a 38% chance of failure that tomorrow morning, when I get on the airplane at the Phoenix airport and fly to Burlington, Iowa, that there was 30% chance of failure, and I knew that, I wouldn't get in the plane. If there was a 38% chance of failure of going under the knife to fix a common illness, I just wouldn't go under the knife. We just wouldn't do things in life with a 38% chance of failure. And yet, those that continue to do things the way we've always done them in the past don't understand that we cannot continue to do what we've always done because the dynamics of what is relevant to our retirement has changed.
One thing I want to point out before we close off the segment, if I just use your 85 age, which I think the average male is like 86.8, and I think the female's 88.8. So if this is a blended for gender for a moment, that means that half of my people are going to live way longer than this. This was where age 90 and 95 come in, because half of these people are going to live farther out down the road.
And not even to life expectancy, 30% chance of failure based on historical performance of what the market actually did. I think it's an amazing chart that reveals a lot.
Well, for more information on how you can use Curtis's revolutionary retirement strategies with your clients and prospects to help you build out your business, just click on the landing page address in the video description. And for more information on our shows, seminars, and workshops, just follow us on social media or visit us out on our webpage. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.